Hey, Carl, good morning. The Fed New York survey of consumer expectations showing a surprising increase in one-year inflation expectations, something watched closely by the Federal Reserve, up a half a point to 4.7%. We had been coming down for about 5 straight months. Now, it's a little bit better when you look a little bit further out. And to be fair, the Fed looks a little more at these time periods where the 3-year inflation expectations was up 0.1 and the to 2.8%, and the 5-year declined 0.1% to 2.5%. But that 1 year, a surprising increase. Now, what's even more surprising is when they asked about specifics, the survey respondents saw inflation expectations declining for gas, food, medical care, and rent. The college costs were seen rising. Apparently, they saw other costs going up. Earnings growth expectations unchanged at 3%. That'll be good for what the Fed wants to see. And the perceived probability of losing your job down 0.4% to 11.4%. So more indications in that part of the survey, guys, that the job market remains tight.
Interesting. Right now, Steve, how would you rate where inflation expectation sentiment ranks on the Fed's list of inputs right now? Versus looking at all things hard data and soft.
It's pretty high. That's the one reason. What's the main reason why they keep saying they need to keep hiking is because they don't want inflation expectations to get out of control. If the idea was that we'd have an inflation bout for a while and we could see it through and not do anything because things would come down, the Fed would be fine with that. But their concern is that you start to ingrain these expectations, Carl, into wage negotiations, into buying patterns right now, and that could create a longer-term inflation problem. That's why they feel like they want to keep going if they feel they can keep going relative to what's happening in the banking sector and the economy overall.